for more on Powell's testimony and how the Middle East conflict factors into the Fed's thinking, let's bring in Fed Watch Advisors founder Ben Emons. Ben, great to see you. I first want to ask you about bond yields being at 4.29 on the 10-year. And I'm just wondering, because this is a day when the markets rallied. We saw oil come off precipitously. All the risk premium got taken out of the oil market at this point, and we didn't have much of a move in the bond market. So at this point, is it really the Fed and the notion that there will be a cut very soon that is holding bonds in place?
I think so, Mel. And it's good to see you as well, because Powell did open the door, I felt, for the rate cuts. At the press conference, he was a bit more stern about it, but in this testimony, he sort of outlined the paths and how they can get to these rate cuts, and that he sees this tariff really the reason why they're holding off. He also quantified that if there were no tariffs, then rates actually could be by as low as 100 basis points from here. So I think that keeps the bond in place, because if you were to cut faster here with more, likely yields are going to rise again, like we saw last year in the fall. So I think to Danny's point, the Fed may have here an opportunity to cut a little bit more in September as there's all this data ahead of them, and then make that decision to do a larger cut. So I think this keeps the yield a bit for more falling further than rather than actually rising. I think it actually has more pressure to rise if the Fed goes faster and sooner.
Ben, it's amazing what an equity rally can do for the rhetoric around, what happened to people were no longer going to be buying treasuries. What happened to supply, the technical issues in the treasury market that were going to trend it towards 4 3/4? Certainly a few days after Iran, and some of the rhetoric, if you read in the global press, is that the U.S. is no longer a reliable partner, and that people would be stepping away. And all we've heard of for 4 months is what, in terms of foreign buyers of treasuries, might be thinking and what global central banks are doing. Have you changed your tune on that at all? And again, I think you've been quite balanced on this, but it's amazing how we're not hearing that discussion about the long end of the bond market right now.
That's true, Tim, and I think my view is still the same there, that there was a bit of a move away from treasuries, and people are wary of that. We have still this big budget bill in the Senate now, through the Senate, but to the House. We obviously have this energy shock that will somewhat come through. We have tariffs, so there's a lot of pressure there under the long end that we could see higher yields that makes people wary. So this counter rally we're seeing currently may be really driven by more domestic players that were perhaps short, other technical factors. But I think the story in itself hasn't really changed. So I think we're going to continue to have this higher pressure on long end of the yield curve, really because we haven't really dealt anything away with the deficit or with inflation for that matter. If in fact, there's more risk now than anything, even though we put a ceasefire in place. This seems actually quite fragile, to be honest. Oil markets could pop back easily and therefore put pressure on long-term yields.
So, Ben, let's shelve treasuries for a second and focus on the dollar, because at last I looked, we're looking almost like a 3-year low in terms of the DXY or whatever you want to look at in terms of U.S. currency. What story is that telling, do you think?
Yeah, I think it's still about whenever we get a bit of relief in markets, it seems that then the economies that benefit from sort of the tariff relief or from this geopolitical relief, that those currencies rally, and why the dollar is in bid. So as you saw today with the euro, for example, touching 116, the ECB has been cutting now 8 times. The economy in Europe is not that strong, but I think it's really about if there is relief from geopolitical crisis, and it seems to be going to other currencies that benefit from this. In addition to that, euro and Brento is quite linked to each other, but Brent is really the contract for Europe. So I think that's really what's playing there, Guy. It's maybe not so much about the flight out of the dollar, but I do think it's related to treasuries, that if treasuries get more under pressure, the dollar will likely get weaker.